With a national coalition expected to win the election, analysts are eyeing upside among aged care stocks.
We would expect to see a more positive environment for the sector. If there is a change of government, perhaps a little bit less pressure on the minimum wage, and an ability to restore margins to kind of more acceptable levels.
It's Friday, the 13th of October, ominous, and you're watching Markets with Madison. Polls have put National, with ACT and New Zealand First, as the most likely coalition government to form as a result of this weekend's election. Analysts, well, they're always looking for a way to make money in any scenario, so I thought you deserved to know what they're thinking. Craig's Investment Partners Institutional Desk says the three parties' policies would boost house prices and unlock growth in the paralysed aged care industry. Well, Stephen Ridgewell from Craig's Insto Desk is here to explain. Hey, Stephen, thanks so much for sharing your research on this one.
Happy to be here.
Can you please explain to me how these parties' policies could boost house prices? Which ones are you looking at specifically?
Restoring interest deductibility for investors. So, back in 2021, the current government announced that, for new house purchases by investors, that interest would no longer be deductible from rental income. And that even for existing homes, that would be phased out slowly. We're down to about 50% at the moment for existing homes. That'll go to 25% April next year, and then eventually be completely phased out. National's proposal is to slowly restore that over time. So they would like to see 50% interest deductibility from April 2024, which is actually the current position, but increasing to 75% April 2025 and then 100% the year after. So that's National's policy. If we look at ACT, they would like to see deductibility reinstated by April 2024, so a bit sooner than National. New Zealand First's policy is a little bit less clear, but it seems they also would like to see reinstatement to some degree. So we think that there will be, some restoration of deductibility is the first point. So that will be attractive for investors in the housing market. The second kind of key change, which will benefit investors, we think from if there is a change of government over the weekend, is that the bright line test would be shortened. So at the moment it's 10 years. National's proposing to reduce that to 2 years. ACT's policy is to abolish the test. New Zealand First, again, a little bit less clear, but they seem to be in favour of shortening it from the current 10 years. So what we'd see both of those policies combined, so restoring interest deductibility and reducing the length of the bright line test, would help support investor demand for houses. That has fallen since that change in policy we saw from the Labour government in 2021. So the month before that policy was enacted, investors made up 22% of all loans for houses, according to RBNZ data, and that has reduced to about 17% the last 12, 18 months. So it has fallen. If you go back 10 years ago, investors made up about 35% of all mortgage demand. So certainly investors have been a lot less active compared to the last, where they were 10 years ago and over the last 2 years. So we do see, potential change in policy there post, if the polls are right, is potentially boosting demand from investors and therefore supporting house price growth.
Are there any policies that a coalition of just National and ACT without New Zealand First, is there anything that could get over the line with just the two of them that would further boost house prices, you think?
Yeah, well, certainly National and ACT are more closely aligned in terms of their policies than New Zealand First. As we've discussed, that there are some similarities between the three. But if it was just National and ACT that can get over the line over the weekend, then there'd be another 3 or 4 areas potentially that could be supportive of the housing market. So probably the key one is reduced or a reduced rate of growth, I should say, in government expenditure, which National historically has been associated with. Certainly the ACT Party is advocating for more restraint than the National, but in both cases, you'd expect to see less spending than the current government, or certainly a lower rate of growth, and that should take some pressure off inflation, and that should lead to lower interest rates, which interest rates are a key driver of house prices, as of all asset classes. So look, if we do see lower inflation, so lower spending, lower inflation, and then lower interest rates, we think that would be really, really important to support the housing market, into next year and future years. So that's key. There's some other potential alignment between National and ACT. So National has come out saying that they will partly remove the foreign buyer ban that came in several years ago under the current government. So they would permit overseas residents to buy houses valued over $2 million, subject to a tax of 15% on the value of that purchase. ACT is in favour of a repeal of that ban. So, the two of them together, you may see even slightly more, a more generous allowance for overseas buyers, and certainly more generous than is at present. And that again would support housing demand. At the moment, National's policy alone would only see some support at the top end of the market, but if there's a broader loosening, then that could see support for more mid-level homes as well. Also, two other kind of key areas we'd see some support for the housing market. Immigration. National and ACT have historically been more pro-immigration than the current government, although noting that we are seeing quite strong net migration right now. But that generally has been supportive of housing demand over time. And then, probably the other kind of key area where you're likely to see more alignment between ACT and National, as opposed to New Zealand First, is on minimum wage increases. Now, National, actually, when they've been in government, you have still seen quite strong increases in the minimum wage. But under certainly the first term of the current government, you really saw the minimum wage stepping up well above inflation. And New Zealand First, of course, was part of that first term of the government. It was one of the key policy wins in the agreement with Labor. And so you saw a relatively fast step up in the minimum wage in that first term from 2017 to 2020. We would expect to see less advocacy for minimum wage growth under a right of centre coalition has historically been the case. ACT, for example, is advocating for a 3-year kind of moratorium on minimum wage increases. So no doubt, it will depend on the rate of inflation as to what happens there, and you'd still expect to see some growth, even with the National ACT coalition, but certainly at a lower rate than it has been increasing in recent years. And how that affects the retirement sector is, wages for a lot of care workers in particular are linked to the minimum wage. And so you have seen relatively fast growth in wages, in the sector in recent years, at a rate faster than funding growth for the sector. And so that's resulted in, profitability in the sector really coming under quite a lot of pressure, to the point where many, care centres have closed. Many of them are not actually even break even level. The best operators are also making very poor returns at the moment. So, the cumulative effect of 6 years of quite strong wage growth being below funding growth has been actually quite severe in the aged care sector, and creating something of a real challenge for the sector. We would expect to see a more positive environment for the sector, if there is a change of government, perhaps a little bit less pressure on the minimum wage, and an ability to restore margins to kind of more acceptable levels.
Just how much do you think profitability could increase in some of those retirement names if there was sort of a moratorium on minimum wage increases?
Well, that would depend on how much funding growth you get, but typically, funding growth increases at the rate of inflation. So, if that was 3 or 4% the next 3 or 4 years, and wages didn't go up at all, you could see a significant increase in aged care profitability. I doubt that would be the case. I'm sure that the operators would be pretty sensible and be pretty fair to their workforce, and generally they do try and match care worker wages, the benchmark that against the rate of inflation, as well as what for the nurses, what DHBs are paying. So there's a number of factors there, but I think that the general story would be, the last 3 years in particular, we've seen a real margin decline in the aged care sector. At the very least, would expect to see those margins stabilise and quite possibly improve a little bit in the next few years.
I want to focus on two things you raised just earlier, immigration and interest rates. Specifically on immigration, it's your view that another big wave of immigration like what we're seeing now isn't actually going to push house prices much higher. Why not?
Well, we haven't seen we have actually got record net migration right now, and while we're seeing house prices inch up a little bit, certainly they're not off to the races. But we were a little bit cautious at a high level, for house prices, is that they are at relatively unaffordable levels to start with. So in previous cycles, we have seen strong net migration leading to strong house price growth. And certainly, some years we've seen 20-25% house price growth in the past. We're in a very different scenario at the moment. So, if you look at affordability, mortgage serviceability, or the proportion of, the average household income being spent repaying a mortgage, at the moment, that's up to 36%. The historic average is 27, right? So the starting point is that we are already currently paying, significantly more than our historic averages to repay a mortgage, which the data suggests does make it hard for house prices to appreciate significantly, in that situation.
On interest rates, all of this pretty much depends on interest rates. How much power does any incoming government, no matter who they are, actually have over interest rates?
Well, it's a good question.
Is the answer none?
No, it's not. Look, fiscal spending is extremely important, and so we have seen New Zealand has been right at the top of the OECD in terms of fiscal expansion during the COVID period, and so and that has been the world has shown the amount of money spent during COVID or fiscal deficits was directly correlated with the rate of inflation that we're seeing in domestic economies. And so, look, it is a choice. We can, as a country, choose to tighten our belt a little bit. And while there is some pain from that, the benefit is lower inflation, lower interest rates. Should flow from that. I mean, obviously, there's global impact as well. That there's a number of factors that impact interest rates, but government spending policy is an important driver of it.
If all of this eventuates as the polls currently suggest, are there any other sort of cyclical names on the NZX that you think could benefit? Discretionary too, perhaps?
The other names. So the retirement names are obviously important in terms of potential beneficiaries of more favourable housing policies. Other obvious names would be Fletcher Building, for example, and there's a few others, but those are kind of the key larger names.
If you look at least the aged care names, their share prices haven't moved much over the past 5 days, at least, despite some sales increase updates. Do you think that the market has fully priced in this potential house price boost?
No, we don't. The market has been pretty cautious on the retirement sector names for the last 2 years, really. Currently, the key names in the sector are trading at about half the historic price to book valuations that they were trading at over the prior 5-year average. So certainly the sector is trading at below average valuations. Investors are still pretty cautious on the operating environment that they are facing. And so there is potential for investors to become more positive on the sector if you do start to see house price trends firm into next year.
Well, we will watch, worry and wait to see what happens both this weekend and next year. Thanks so much for your time, Stephen. Appreciate it.
Thank you.
Well, I wish I could say I'll be watching the election at home with popcorn in hand, but I'm actually hosting the Herald's Election Night live stream. So please come and keep me company. You know me, and I will throw in as many market references as possible. Now go put your money to work.